Imagine waking up tomorrow morning. You roll over, grab your phone, and check your bank account. Another deposit. Not from your job, not because you worked overtime, not because you sold something, but because you simply own pieces of great companies. Now imagine that happening again next month, and the month after that, and every month for the rest of your life. It almost sounds too good to be true, but that's exactly what dividend investing is designed to do. The problem is that almost nobody explains the most important question. How much money do you actually need invested before your dividends can completely replace your paycheck? Is it $100,000, half a million, 1 million, 2 million, or is it even more than that? Today we're going to break down the exact math, how dividends actually work, the biggest mistakes beginners make, and the smartest strategies that can help you reach financial freedom years sooner. Because once you understand how this works, you'll never look at investing the same way again. Let's be honest, most people don't actually dream about becoming millionaires. They dream about freedom. Freedom to spend more time with family, freedom to travel, freedom to choose where they work or whether they work at all. Money isn't the goal, freedom is. And that's why dividend investing has become one of the most talked about investing strategies in the world. Instead of relying on a paycheck forever, dividend investors build a portfolio of companies that can pay them a portion of their profits over time. Think about it like this. Imagine owning a small pizza shop. Every month, after paying employees, buying ingredients, and covering expenses, there's money left over. As the owner, you get to keep those profits. Owning dividend stocks works in a similar way. When you own shares of certain companies, you're a partial owner of that business. If the company decides to share some of its profits with shareholders, you receive a dividend. In other words, your money starts working instead of you. But before you start imagining yourself retiring next year, there's something important you need to understand. Not every company pays dividends. Not every dividend is safe. And the amount of money you'll actually need depends on several key factors. So before we calculate the exact number, let's first understand how dividends really work. So, what exactly is a dividend? The easiest way to think about it is this. Imagine you and 3 friends own a lemonade stand. At the end of the month, after paying for the lemons, sugar, cups, and everything else, the business has $400 in profit. You have two choices. You can keep all the money inside the business to help it grow, or you can split some of those profits between the owners. That's exactly what many public companies do. Companies like Coca-Cola, Pepsi, Procter, and Gamble, and many others earn billions of dollars every year. Instead of keeping every dollar they make, they often choose to share a portion of those profits with their shareholders. And if you own shares of that company, you get paid. Sometimes every 3 months, sometimes every month, depending on the investment. And here's the crazy part. You don't have to work another hour to receive that payment. Your money is earning money simply because you own part of a business. Now, that doesn't mean every company pays dividends. In fact, many fast-growing companies choose not to. Instead of paying shareholders, they reinvest those profits back into the business to grow even faster. Neither approach is automatically better. Some investors prefer companies that pay steady income today. Others prefer companies that focus on growing their value over time. It all depends on your financial goals. But if your dream is to eventually live off passive income, understanding dividends is one of the first building blocks toward making that possible. Now that you know where dividends come from, let's answer the question everyone clicked on this video to find out. Exactly how much money do you need invested before your dividends can replace your paycheck? So, how much money do you actually need invested before your dividends can replace your paycheck? The honest answer is, if your yearly expenses are $40,000, you'll need a much smaller portfolio than someone who spends $100,000 every year. That's why the goal isn't to chase someone else's number, it's to calculate your number. Let's use a simple example. Imagine your investments generate an average 4% dividend yield each year. If you wanted to earn $40,000 a year in dividend income, you'd need roughly $1 million invested. Want $60,000 a year? Around $1.5 million. Need $80,000 a year? About $2 million. And if your goal is $100,000 a year, you need approximately $2.5 million invested. At first, those numbers might sound impossible, but here's what most people don't realize. Almost nobody reaches those numbers by saving millions of dollars. They reach them by investing consistently, allowing their money to grow, and giving compound growth decades to do the heavy lifting. The average person sees $1 million and thinks it's out of reach. An investor sees $1 million and asks, "What's my first step?" Because every large portfolio started with a first investment. Every millionaire bought their first share. Every snowball started as a single snowflake. And the earlier you begin, the less money you often need to invest each month to work toward the same long-term goal. That's the real superpower of investing. It's not trying to get rich overnight. It's giving time the chance to work in your favor. Now, here's the part that completely changed the way I looked at investing. Let's say you buy your very first dividend stock. A few months later, you receive your first dividend payment. Maybe it's only 50 cents. Maybe it's $5. Most people look at that and think, that's it? But experienced investors see something completely different. They don't see the amount. They see proof that their money just made money. And instead of spending those dividends, they reinvest them. That means those dividend payments are used to buy even more shares. Now you own a little more of the company. Those extra shares can generate even more dividends, which can buy even more shares. And the cycle continues. It's like planting a single apple tree. At first, you only get a few apples, but if you use those apples to plant more trees, eventually, you don't just have one tree, you have an entire orchard. That's exactly how compound growth works. It starts slowly, so slowly that many people quit before they ever see real results. But over time, that snowball begins rolling downhill. It gets bigger, it gets faster, and eventually, your portfolio starts growing by more each year than you could comfortably save from your paycheck alone. That's why starting early matters so much. It's not because you'll pick the perfect stock, it's because time gives your investments more opportunities to grow, reinvest, and compound. The biggest mistake isn't starting with a small amount. The biggest mistake is waiting for the perfect time to begin. Because while you're waiting, time, the most valuable asset an investor has, is quietly slipping away. Now, before you start investing every dollar into dividend stocks, there are a few mistakes that can cost people years of progress. The first mistake is waiting for the perfect time to invest. A lot of people tell themselves, I'll start when the market drops. I'll start when I make more money. I'll start next year. But the truth is, the market doesn't wait for anyone, and neither does time. The second mistake is chasing the highest dividend yield. This one catches a lot of beginners. They see a stock paying an incredibly high dividend and assume it's the better investment. But sometimes a very high dividend is actually a warning sign. A company that's struggling may offer a high yield because its stock price has fallen dramatically, or because the dividend may not be sustainable. A high yield doesn't automatically mean a high quality investment. The third mistake is putting all of your money into one company. Even great businesses can go through difficult times. That's why diversification matters. Owning investments across different companies and industries can help reduce the impact if one business struggles. Another mistake is expecting overnight results. Dividend investing isn't exciting every single day. You probably won't wake up rich next month, but that's exactly why it works for so many people. It rewards patience. And finally, don't invest money you'll need in the near future. The stock market can move up and down over short periods. Money for next month's rent, emergency expenses, or essential bills generally shouldn't be invested with the expectation that it will be there exactly when you need it. The investors who build lasting wealth usually aren't the ones chasing shortcuts. They're the ones making smart decisions over and over again for years. So, can you really retire on dividends? The answer is yes, but not because dividends are a shortcut to getting rich. You retire on dividends by consistently investing in strong businesses, staying patient, and allowing time to do what it has done throughout history. Think about companies like Coca-Cola, Procter and Gamble, and Johnson & Johnson. These aren't exciting overnight success stories. They're businesses that have been serving customers for generations. Many of them have rewarded shareholders by increasing their dividends year after year, earning titles like Dividend Aristocrats and for a select few with even longer track records, dividend kings. A dividend aristocrat is a company that has increased its dividend for at least 25 consecutive years. A dividend king has done it for 50 consecutive years or more. Just think about that for a second. Some of these companies were increasing their dividend before many of us were even born. They've paid investors through recessions, market crashes, wars, inflation, and economic booms. Now, of course, no company is guaranteed to keep paying or increasing dividends forever. Every investment carries risk, and past performance doesn't guarantee future results. But history shows that businesses with long records of rewarding shareholders have often demonstrated remarkable resilience over time. That's why so many long-term investors focus on owning great businesses instead of chasing the next hot stock. Financial freedom isn't built in a weekend. It's built one investment, one paycheck, one dividend, and one smart decision at a time. Remember, you don't need thousands of dollars to begin. You don't need to be an expert. And you don't need to wait until you're older. What you need is a plan, the discipline to stay consistent, and the patience to let time work in your favor. Because every day you wait is one less day your money has to compound. The goal isn't to become rich overnight. The goal is to build a portfolio that can eventually provide enough income to support the life you want to live. That's the real power of playing the long game. If you enjoyed this video, leave a like, subscribe, and let me know in the comments. If your investments paid all of your monthly bills, what would you do with your freedom? Thanks for watching, and I'll see you in the next one.